In this video, I'm going to show you 5 reasons why retirees who started with just $100,000 ended up with $2 million or more by the time they retired. And it's not what most people think. It is not picking the right stock at the right time. It is not getting lucky with the market. It is not even about how much money they made during their working years. It comes down to 5 very specific things that almost nobody is doing right now. And by the time we are done here, you are going to understand what those 5 things are, how to put every single one of them to work on your own retirement strategy starting today. Reason number 1, the power of compounding interest. Compounding interest is one of the harder ones to see, but can be extremely powerful in how your money actually grows. If you think about it, $100,000 growing at roughly about a 10% yield, which is normally what the average is on the S&P 500, grows to be over $1.7 million in roughly 30 years, which seems like a long time, but let's break it down to something maybe most of us have done. Have you ever gone golfing and you're gonna go out with your buddies and you're like, hey, let's bet per hole. Let's say we bet $1 on hole number 1 and we're gonna double it every single hole. Now, if you think about it, you're like, you know what? We're starting at $1. That's not a big deal, but you better be a damn good golfer if you just made this bet. Because by the 18th hole, if you double starting at $1, so $1, $2, $4, $8, 16, right? Doesn't seem that bad. But by the 18th hole, that's a $137,000 bet you just made on this one hole. But the fact is that if you make that same bet on your retirement plan and we keep investing and we keep letting it grow at that 10% rate of return, that's the average for the S&P 500, you're going to put the winning side in your favor by doing so, because now that compounding effect is actually going to help your retirement funds grow even more. So again, make sure you put money away, put it into the market, and just let it be. Now, I know what you're wondering. Brian, what happens if the market crashes? You're screwed. I'm just kidding. It's not really true. The fact is the markets go up, they go down. It's gonna happen. It's just how they've always worked for many, many years. Even if we go back to one of the most recent horrible crashes of 2008.
Points or so, Apple shares are just getting hammered this morning.
At the speed with which we are watching this market deteriorate, we're down over 16%.
2008 went down over 50%, and it lasted over 1 year. But it recovered fully within 3 years. So 3 years isn't horrible. So yes, 3 years is gonna suck and we're not gonna be happy. But if we had that money, within the 3 years, we're back to where we started and that compounding keeps going in. So it's not about being able to time the market and figure out when the next crash is gonna happen, or it's not about being so scared that you don't actually take action and put the money into the market. What it is it's about knowing that long-term compounding is going to help you out in retirement. Now, compound interest is the engine, but the engine needs fuel. And that brings us to reason number 2, contributing consistently. Most studies out there show that millionaires with $1 million in their 401k have contributed consistently to those accounts over 25 years. And the other studies have shown that over 75% of self-made millionaires, they were able to contribute consistently to those accounts. You can make it so consistent that your accounts get hit and they fund your 401ks, your Roth IRAs, your brokerage accounts, your other accounts consistently every single month, month in, month out. There is absolutely probably no way that you aren't going to end up with a lot of money for your retirement if you're doing it for 25, 30 years. You have to make it so that it is consistent. The way I always tell people to do is make it automatic, because willpower will fail, but making it automatic where it comes out of your account regularly without you ever thinking about it doesn't fail. Computers are helpful in this regard. But here's the thing. Even if you contribute consistently for 25 years, there is one more thing you have to do, or none of it works. And reason number 3 is where I see most people lose all the momentum they've built up over decades. That being said, reason number 3, staying in the market even when the market drops. This one can be hard because when the market's going up, everyone has kind of the FOMO mentality, the fear of missing out of, oh, crypto went up, let me buy crypto. Microsoft went up, let me buy that. The fact is it doesn't matter what the stock is or what the investment is. There's going to be an investment that's going to do extremely well. But the flip side is that times turn, markets change, and the corrections happen. And we could be down 20, 30, 40, 50%. It happens, we've seen it. But what happens is that if you are invested too aggressively, too much into one single stock, what's going to happen is you're going to be overexposed. And when that happens and the market corrects and now you're down 20, 30%, One big thing is we don't lose in percentages. We lose in dollars. When I have clients come in and the market's down 20%, it's not 20% down to them. It's $200,000 on $1 million account. And they will tell me it's $200,000. The fact is we lose in dollars, we gain in percentages. But what we need to realize is that we need to find your capitulation point, which really all that is just a fancy way of saying we need to find the point where you say, oh crap, it's different this time, get me out, I need to do something different. Because when that happens, we are going to change your investment philosophy. We're changing how you're invested. And if we lose aggressively, and now we're down 20, 30%, and we think we're going to gain back that same way after we change our portfolio to being more conservative, there's just no way it will happen. Because think about this, if we started with $100,000 and it goes down 50% and now we're at $50,000, it doesn't have to go back up 50% like we lost. It has to go back up 100% to get us back to where we started. It has to go up more. So you can't be conservative when you lost aggressive. So the key piece is finding kind of that sweet spot that you can weather these ups and downs, right? The fact is you'll hear people say, oh, get out when the market's going down or get in when the market's going up. And yeah, timing sometimes works, but most of the time it doesn't. And we end up being wrong more times than we ever like to admit. And so that's why staying the course and keeping aligned with what is right for you and your investment philosophy and your risk tolerance is the key to success in weathering all of these crazy markets we see. But staying in the market is half the battle, because even if you do everything right up to this point, even if you contribute consistently, even if you never panic, there's still one silent killer that quietly eats away at your returns. And most people have no idea that it is happening. So reason number 4, high investment fees. These are the silent killer to the portfolio. These are the fees you're not seeing. These are the fees that are on the mutual funds, the ETFs. They're disclosed, they're definitely there, but the fact is they sometimes hide them in those gigantic prospectuses that everyone gets because you have to. But what do we do when we get them in the mail? We see the big packet, or maybe we get emailed, and you know what we do? We don't read it, we just take it and we throw it right in the trash. And you need to be aware of what you're paying for when you're buying any type of investment, whether it's an ETF, a mutual fund, an annuity, an insurance product, an alternative, a real estate. Any type of fee that is out there, these are the fees that eat away at your profits, the money that is yours. So when you're looking at an investment, we'll just use ETFs for right now. If we're comparing ETFs and one is charging you 3 basis points, which is 0.03%, versus one that's charging you 1.5%, that can have a huge impact on what your total return is and what you're actually keeping. So watch your fees, watch your account, and let your bottom line grow. So I know what you're thinking. You're like, how do I find these fees? Where do I go? Well, you don't have to look too far, but if you have a 401k, typically it's gonna be on that quarterly statement you have, or you could take the tickers that you have as far as your mutual funds, and you type them into Yahoo Finance, and you'll be able to pull up what the actual expenses are there. If there's other administrative expenses, sometimes those will be in your summary plan description that you get when you started the plan, or you can ask your plan administrator, they can give those to you as well. Obviously the fees sometimes are hidden, but you definitely want to spend the time to find out how much are you actually spending, because again, it does add to your bottom line. But here's the final reason, and this is what separates the retirees who built $2 million and the retirees who built $2 million and get to keep $2 million. Reason number 5, the types of accounts that you have. A lot of people will put all of their eggs in one basket by putting all the money into the 401k and not saving in any other types of accounts. And this kind of puts you behind the 8 ball when it gets to retirement, because the money comes out of the 401k, meaning that every dollar you take out of that 401k is going to add to your earned income for that year and is going to be taxable at whatever the current tax rates are. And so if you're completely living off of your 401k and that at one account, it's going to cost you quite a bit, and you might be in the same tax bracket that you were in when you were working. And so the savings in that 401k wasn't ideal for you. So the trick is to have multiple different accounts. You can have your pre-tax accounts, which are your 401ks, your SEPs, your simples, your profit sharing, things like that. You can have your after-tax accounts, which is going to be your Roths, which can grow tax-free. And then you're gonna have your other accounts, which are gonna be your brokerage accounts, which are after-tax dollars, so you're not paying taxes on the principal anymore, but you do pay taxes on the growth at capital gains rate, which are much less than income tax typically, depending on the rate that you're at. So having a mix of these kind of accounts is going to be the key to making that retirement last and keep more of the money you saved and not have to send it away to taxes, So when you get into retirement, you can pick to say, hey, you know what? I want to limit how much I take out of my 401k so that I can manage what my tax bill is going to be for that year, comparing it to what I get from maybe a military pension or what I get from Social Security. And then I can maybe supplement that with a little bit from my 401k, take a little bit more from my Roth or take more from my brokerage account so that I'm not having to pay more in taxes. And so it's kind of a game that we have to play to figure out what is going to be the correct allocation or the correct fit for you when we're pulling from all of those different accounts. But having those three types of accounts, the pre-tax, right, is the 401k, the post-tax, which is the Roth or gross tax deferred, and the also post-tax of more of a brokerage account, that money at will. Having those three accounts is going to give you the most flexibility and give you the most opportunity to have a great retirement and not have to spend inordinate amounts in undue taxes that no one really wants to pay. So let's bring this all together. So the retirees that start with $100,000 and ended up with $2 million or more. They did not make some genius investment that no one else thought of. Reason number one, understanding compounding interest. Reason number two, they contributed consistently. Reason number three, they stay invested when everyone else was panicking. Reason number four, they paid attention to fees and they kept their investments simple. Reason number five, they built their wealth over multiple different types of accounts. None of these 5 things require you to be smart with money. None of them require you to make a high income. None of them require you to be lucky. They just require you to know what actually works and stay committed to it. And look, I've said across the table from a lot of people over the years. People who have done everything right on the first 4 things and got crushed on the 5th. They built the wealth, but they never built the structure around it. They spent their entire retirement giving more to taxes than they needed to. This is the gap I want to help you close. If you actually want to take your retirement seriously, book a call with me. It won't cost you anything, and I'm genuinely excited to see you there.